What factors should investors consider when deciding between residential and commercial real estate investments?
Great question. Great question. I mean, at the end of the day, real estate is so localized. Like, make sure you've got a good agent. Make sure you understand what you're getting into. Residential, you can design and acquire a portfolio arguably a little bit quicker, lower price points to entry when it comes to real estate. So you can, kind of diversify in and out of your local area or other areas across the country. Commercial real estate's a whole nother animal.
Yeah, it's a whole nother animal.
And so, higher price points to entry, you're dealing with lease contracts, you're dealing with potentially multiple tenants, it's just a whole nother world.
It is
right?
another, yeah. And the reason we bring Baxter Walker in from Avis and Young in here, 3 times a year, is because he reminds us that it is a way different animal than residential real estate.
Right.
And it's not that it's not an effective investment tool, but it is extraordinarily different.
Right.
And you are talking about typically a much larger investment than you would in some sort of residential real estate.
Right.
So there's certainly, you're absolutely right. How do you assess the potential risks and returns of real estate investment property?
First and foremost, starts with cap rate. You mentioned it earlier, right? I think it's really interesting because I've run into people all the time that, kind of look at, what their property portfolio looks like and providing them advice on it. And then I calculate the cap rate and show them that they're making 1%. And they're like, oh no, that can't be.
Yeah, no,
like,
it can.
Actually, it can be.
Yes, it can be.
Is.
No, it actually can be. It can be even less sometimes. Yeah,
exactly. Especially in a higher interest rate environment where you can get way more than that just sitting on cash.
Right.
So I mean, that's the first thing to really understand too, because the appreciation variable and the assumption of what appreciation you're going to get can also vary wildly, right? And we don't know. We can't know the future, right?
We don't know. Yeah.
We've got to put some type of assumption that's in there, but the best way to look at it from a risk return standpoint is, okay, what's your current income, right? Because if that's going to how you play it, for instance, it's part of your retirement income strategy. You've got Social Security, pension, IRA distributions, annuities, stock dividends. And at the end of the day, real estate can also be a piece of that. So it's just calculating, like, what is this making me? And then the second question is like, what's my alternative?
Right.
In the example, you're making 1% on a real estate income or property. What's the alternative? How much time are you putting into that as well? I think it's one thing a lot of people don't really think about. It's like ROT, return on time.
Yeah. Right.
They're managing themselves.
Right.
Property management companies charge, 10, 15, 20%.
Whatever the percentage.
Yeah, whatever the percentage is. So it's just kind of just knowing and understanding, what you've got to make sure that you're making the smart decision for the path forward. It's just like we talked about with public REITs, like a real estate investment trust, mutual fund, ETF, what have you.